Oh, listen, I think semis.
Special guest trader tonight, Sam Coe. Sam?
Buy Nike shoes, not Nike stock. Happy Father's Day.
Couldn't have said it any better myself, but you want to use calendar spreads at Nike to make that bet.
He's excellent on TV.
That's one shot.
All right, so you probably couldn't make out what was going on right there. That was a snip from the old CNBC show Options Action. That one, I believe, was from June of 2018. And the reason I grabbed that snip, the person sitting to my right, or standing to my right, is my son, Sam. He doesn't look anything like that anymore. I don't look anything like that anymore either. Melissa Lee and Dan Nathan, I think, both arguably look better today even than they did then. But we're going to talk about that today on Open Interest. Hello, everybody, and welcome. I'm Mike Coe. What we had hoped to do there was actually show you a snip from an options action, the tail end of the show, right before Father's Day weekend. I believe that was in 2018. What you probably could not hear my son Sam saying was that he was recommending that you buy Nike shoes and not Nike stock. As a reminder that in the short term, the market is a voting machine, but in the long term, it's a weighing machine. I thought we might just actually show a chart of Nike since that time. So I'll pull that up here. I think Father's Day was, well, if I put in mid-June, it'll probably be about right. I think this was the correct year. So you can see it's had quite a roller coaster ride since then, but it has not been a terrific place to have your money. The share price is down, I think, 40% or thereabouts. Yeah, down about 40% since that was recorded all that time ago, and it obviously had quite a ride in the meantime. Took off and then fell back. An important thing to remember, too, about all of this is that while that was going on, there was, this whole thing where people started trading shoes. They became, there were rare shoes that were getting, incredible prices. I think I remember my kids even saying that they knew people who had bought shoes that went to $5,000 a pair or $10,000 a pair. Both my kids would keep their the shoe boxes that their shoes would come in. Oftentimes they wouldn't wear them. Because they were becoming valuable, apparently. Here's the interesting thing. So what got me thinking about this before we went live today is I was talking to some colleagues, and they said, surely this stock has got to be a buy now, right? Because it's fallen back so far. And they said it's back to 2015 levels, and indeed it is. It is expected for the current fiscal year, though, to make not what they did in 2015, but actually to make what they made in 2012. And in fact, even at this low price, the stock is basically trading at around 30 times anticipated earnings for the fiscal year that's going to end this coming May. So under considerable pressure. Now, I want to say that I thought the company did the right thing by bringing Elliott back in, Elliott Hill, as the president and CEO. Longtime Nike guy. He got passed over for the role of CEO, and he ended up retiring, and then he was brought back. But the issue that we are facing when you look at a company like Nike is that a lot of the dynamics that led to that explosive growth for a brief period and into the pandemic and the frenzy that was going on with collectible shoes and all that, a lot of that, that bloom is off the rose. And when it comes to apparel, they were giving up some of their territory to the likes of Lulu, who in turn has started to give up some of their the ground that they were making to Viore. And you have new new competitors like On Holdings. I was checking with people who are a lot younger than I am that I work with, and said, "How much Nike stuff do you guys buy these days?" The very same people who are prepared to buy the stock. I said, "Are you buying their stuff? Are you buying any Nike apparel? Are you buying Nike shoes?" And the person who was talking about apparel said, "No, I definitely prefer Viore." And the person on the shoe front said, "I used to, but I prefer Solomon shoes." So I think it's an interesting situation. This thing is going to be a turnaround story one of these days. But for anybody who's looking at this, thinking that now is definitely the time to buy it, I wouldn't be too terribly sure. So here, this is what I was just talking about 2.2, 2.3 billion in net income anticipated for the fiscal year that's going to end at the end of May. And as I was just saying, if we go back in time to, I think that's roughly equivalent to what they were doing in 2012, if memory serves. Just take a look. 2014, 2013. Yeah. So that's almost exactly what they were doing in 2012. Almost it's within, a percent or so of the full year in 2012. There is a difference, and that is that in 2012, the company had more than $3 billion in net cash. In 2015, it had closer to $4.5 billion in net cash. And now, fast forward to today, that's not what we're looking at. Instead, you're actually now at about $3.2 billion, $3.1 billion or so in net debt. That's not a heavily levered balance sheet, but it just illustrates the point that, when you look at a situation like this, and I'm sure many people are tempted. I was just joking with some of my colleagues. Their logo, their motto is "Just do it," and what I said is "Just don't." I do think that this is one to keep an eye on, but I would absolutely wait for some sign that it's making a bearish to bullish reversal, and we have no sign of that just yet. Just had this big gap down. Although I will say that, one of the things that Carter Worth likes to talk about sometimes is that when you get this big sell-off, sometimes the market can be very efficient at repricing a stock at some new level. So, if you can, say, for example, sell a call where the stock was before all of this and sell a put, some level below, it seems unlikely to get much higher than that because, what you're going to end up with is a situation where the stock recovers back to the level where people were in the stock prior to earnings and hoping the news would be good, turned out not to be, and they would be very happy to get their money back. Another similar story is Restoration Hardware. And this one also gapped lower on the back of their earnings. This is a little bit different situation, very high short interest here, and the valuation was a little bit harder to get one's arms around when we take a look at how high it had been. Now, the reason I'm looking at both of these is because we're short both of these stocks, and we were short both of these stocks going into the print. Yesterday at our investment committee meeting, Restoration Hardware actually, the systems that we use to screen for potential short opportunities, was actually saying, Restoration Hardware was no longer on the list, net of its decline. And the CIO said, I don't care. I want to continue. I want to lean into the print. I want to stay short both these names. And needless to say, I put it into the chat today that was a solid decision because it can be very difficult. If you are short a stock like this one that has obviously fallen as far as it has, and you're thinking, my God, it's down all the way over here. So, from its prior highs. We haven't been short it this whole time because that fund hasn't even been around that long. But certainly they've been short it all year. It's down now 50%, if you can believe it. from its highs of this year. And if we go all the way back to 2021, we can see that it's now down. What is that? 85, 86%. But one of the things I wanted to bring up as we look at this is, number one, if you're thinking about getting long the name and saying, okay, well, the Nike logo is apparently one of the best known logos in the world. I think somebody said that if you put all of the logos of all the major companies up, that's the one that basically gets the most recognition anywhere. What I thought I would do, though, is go back and say, okay, why was it that when my son Sam was on CNBC on that occasion, he was not in favor of the stock? Because right before we went on air that day, I said, we're going to put you on air and you can talk about a company that you want to talk about. And he was a big fan of Nike products. That's sort of their heyday, if you will. And he said, how about Nike? And I said, how about it? Okay, so let's take a look at the company together. And we did. And the gist of it was that I said, okay, when you buy a stock rather than the products, you love the products, and that's important. But when you buy a stock, what you're doing is you're buying their earnings. And so I said, at this point, the earnings that you get from Nike, for every $100 that you invest, you get about $2 back every year. And at the time, the S&P, I said, if you invest $100 in the S&P, you're going to get about $4 back. So which one do you like better? He said, well, I like the S&P better. He didn't even know what the S&P was. And so I said, yeah, so you put your investments into S&P and put your consumer discretionary money into Nike shoes. And that's why he said on that day, buy Nike shoes, not Nike stock. So that's where we're at right now. James Forbin is asking, what is Nike's total addressable market, past and present? They have much more competition in the last few years. Yeah, that is 100% true. Look, I mean, the addressable market for products like this, as long as the population is growing, right? So there is a market out there that is large enough to get Nike's revenues back to, call it 51, 52 billion bucks, which is where they were only a couple of years ago. Even higher if you think about it on an inflation adjusted basis. So the company could it do 60 billion in revenues? Sure. Could it do 100? Sure. I mean, this is a very big market. But that doesn't necessarily mean that they will do that, because this is also a very fickle market. A lot of people liked Air Jordans because of Michael Jordan, and that's almost its own separate thing. But, they are getting a lot of competition. They get competition in sports apparel from companies like Lulu, as previously mentioned, which in turn is getting it from Vuori. Adidas is increasingly popular. I've always said Adidas, but I've heard somebody else say that that's how you say it, so that's how I'm saying it. This is the competition that the company is facing. But there is something else, which is, I don't know that we're going to go back to trading shoes, where a limited production run shoe is suddenly going to be worth $5,000 or $10,000. Maybe, but that was very much a product of that pandemic period. When everything became collectible and there were shortages of stuff. So I don't really see it. So what I would say is, instead, look to the margins. Okay, so just assume, for the sake of argument, that the company can maintain approximately its current sales, and maybe it gets back to growing at the pace of GDP growth, so you can get 3% growth if they can stabilize the appeal of the brand. And let's further assume that they can get their net income margins, back to not the peak that you saw in this post-pandemic period, which is, I think, what a lot of people were banking on. They just thought, oh, okay, this company's going to do 13% net income margins. It's a consumer products company, right? And instead say, okay, I think it's probably at, when it's working and it's operating well, that those numbers are probably going to be closer to, if we look at the averages, it's probably going to be closer to, say, 7.5. So here we can see in 2018 it was 5.3, and we can see that more recently it's in that same neighborhood, single digits, 4.8. So these kinds of forecasts, I think, are fairly realistic, right? So you got 7.6% net income margin, fairly tepid growth. That gets you back to $49.5 billion. We're looking at $3.7 billion. So effectively, if you think about it that way, the company right now at a $70 billion valuation in round numbers is trading at just under 19 times full year not full year calendar year, but full fiscal year 2028 numbers. Not terrible, but not cheap. And as you know, we like to look for things that are fairly obviously cheap, and we're looking for better growth than this. So if it gets a little bit more bombed out, the thing gets down to like 15 times earnings, which is 3-4 turns cheaper than we are right now. So that's going to be down another 20% or so. So around $40. Maybe we'll take another look at it. But I kind of thought this was an interesting one to think about, and so I figured I'd bring it up because we had a position in that one, and Restoration got hit even harder. Okay, MDM, you were right about the skew on VCX options that started trading today. OCK 115 calls are $34, and the puts are $70. Tough collar to swallow. So, well, first of all, that wouldn't be a collar. That's just a synthetic. A collar would be if you had an out-of-the-money put and an out-of-the-money call. So let's just take a look at this, though. This is what I was talking about before, where you can see the implied forward, and we can get a sense of how hard to borrow and how expensive it would be to borrow a stock forward. So for those who don't know, this thing only recently began trading. It has had an absolutely wild ride. Let's actually just take a look at the chart so you can get a sense of this. So this is basically since the stock started trading. This actually doesn't even tell the whole tale. I should really put the candles up here because, in fact, what we're looking at is something that intraday got to over 500. Oh my gosh, it got over 550. So there you go. So, been as low as $30 basically. It's been as high as 575, and now it's back to 115. So these are some pretty violent moves, and this kind of price action is the kind of thing that you get. So basically from its first moment of trading, it was up 1,740% in 5 trading days, and since that time, it's down 80%. Still substantial, still up 270% since it started trading, so quite substantially. When you see this kind of price action, that's usually indicative of a stock that's hard to borrow. There's no real way for anybody to sell it. Okay. So you're wondering, how hard to borrow is it? Maybe you look into it and your brokerage platform says, oh, it costs you 50% is the short rate, for example. That means that that's the annualized rate that you're going to pay on an overnight basis to borrow the shares and sell them short. But there's another way you can kind of get a sense for how much that's going to be, and that is to go out and take a look, for example, at the money puts and calls. I'm looking at the 115s right here. And so this is out to October. And you can see that the midpoint on these calls is about 31.5. They're 30 bid at 33. And the midpoint on the puts is in, the low 70s. We'll call it $73. Okay? So $73 versus 31.5. So I can just say 31.5 and then $73 minus. So that's negative 41.5 plus the strike. So I'm taking the call plus the strike minus the put. And that gets me a forward price of $73.5. 73.5 is down basically 36% from here. 36% over 198 days, right? So that's about 0.54 a year, right? So 0.36. So that means that the implied term cost to borrow the stock is going to be about 67% annualized rate of interest, right? So even if this was a stock that you liked, you would never ever just buy the shares here when you could just buy the synthetic, right? You could buy the call and do much better. So I think that's something to think about. The other thing is that when you look at this, what you're going to see is that the implied rate is going to plummet right after whatever it is that the market anticipates is keeping the stock hard to borrow for now. What is that? It's going to be the lockup, right? So once that lockup frees up, presumably the stock will become much easier to borrow thereafter. So what you'll typically see is you'll see a very high borrow cost. It will probably typically drift down a little bit because people are assuming that the market's going to kind of find its footing a little bit. And then you look to the lockup, and then from that point forward, there's not going to be a huge cost to borrow. So if you do a September synthetic, let's say that the lockup ends in early September, and I believe MDM, you said it does, then you're going to see that the September options, if and when they list, this one doesn't have weeklies or every month, so it's got the October options. But once you do see the September's list, or you're going to basically see how the rates to borrow the stock are just going to remain elevated till the lockup, and then they'll just drop. But yeah, so that's what we're seeing there. I think that's kind of interesting. Youth is wasted on the young. I took a flyer today on there being a negative reaction to the 9 p.m. speech. Bought 11 SPX 6510, 6505 bear put spreads for 50 cents. I assume those are the ones that expire tomorrow then, because that's paying 9 to 1, 50 cents on a $5 put spread. But where do we close today? That's an interesting idea. It's a good trade, actually. I mean, it's not a high probability trade, but it's a smart trade. Wish I'd thought of it now. I mean, I was actually in a meeting for 2 hours right before the market closed. I was spending a lot more time thinking about Restoration Hardware and Nike and Salesforce, which is another stock that is in our short book that hasn't performed particularly well. It's down 30% on the year. There was a very interesting post. Maybe I can find it. Some of you are probably familiar with Zero Hedge. Zero Hedge, they, what would Tyler Durden do? They have a website, a lot of information on there. But they also have an X handle. So can I find that? Let's see if I can find it. And they had a really interesting chart. And the chart was, where is it? Oh, here it is. Let's see if I can find it. It was about Salesforce. And of course I can't find it, but that's okay, I can show it. So here's what we're gonna do. This is, maybe somebody can just get into my ear and tell me, when was Salesforce added to the Dow Jones Industrials? The Dow, that was a couple of years ago. So it was added, it was added all the way back on August 2020. I didn't realize it was that long ago. August 31st, 2020. Salesforce was added to the Dow Jones Industrial Average. And, I mean, you can see basically what has happened there since. Okay? And what got removed? And the answer is that they took, believe it or not, they took Exxon out. So we're going to put those two on a chart together. So sometimes in the S&P, this would probably not happen, but so that, yeah, Salesforce is down 34% since that time. And Exxon is up. Is that correct? Where's the end of that chart? I can't quite make it. That much, 300%. So just kind of an interesting observation right there. Something else that I thought was kind of interesting, because we do have positions in a lot of the energy names, but Exxon starting to look a little bit more intriguing from a buy right perspective. And the reason for that is that this has never really been it's not a super volatile stock, but it's getting there now. So if you take a look, you've got 34% implied volatility going out a month. How high is it for 2? Is it similar? So yeah, this might be an interesting situation if you own the stock, that you might start thinking about selling some upside calls or call spreads just to give yourself a little bit of a boost. I mean, the thing's had a nice run. You don't want to get too greedy, and you can sort of see how much of a run we've had here. And the green one is the price, and the white one is the price of options. So I actually don't really need to have the historical fall. That's kind of less relevant. So the idea here is the stock is up, the options prices are up. You've had a really nice move. Maybe think about selling a little upside off of there. Might be interesting. All right. Bunny, regarding a delta neutral buy, SPY, April 2nd, 655 puts with stock. When do you usually roll the SPY put? Before expiration, or if SPY goes more than 40 delta? So if I'm trading it delta neutral, the 40 delta put doesn't necessarily need to be rolled, because I'm busy adjusting my deltas anyway. But I would roll it before expiration, because otherwise you're going to end up with a gap, right? So if you're long, so you're long the put, so you want that convexity. These options are going to expire tomorrow. If you do not roll before expiration, here's what's going to happen. You're going to go a 3-day weekend and wake up Monday without any convexity on. Now, maybe that suits you just fine, or maybe you feel that options premiums are too high. But you might also think, these days, with what's going on in the Gulf, a lot can happen in 3 days. And what is going on in the world right now is not taking a break because it's a long weekend. Far from it. So I would probably be inclined to adjust my position intraday tomorrow on that. Typically on options where I just get long an option and I'm not delta hedging it, though, if I'm in a 30 delta option, I'll usually look to roll or adjust that when it gets to 60. 60 delta would typically be the case. All right. Eileen, what a sweet clip. Yeah, thanks. I was telling somebody earlier today, my son Sam doesn't look. First of all, he's taller than I am now, and he doesn't look much like that anymore. He's going to be going to college next year. But yeah, it was nice to dig that up, because I remember, because Nike had that big run, he was watching the stock, I guess, with some interest in saying, I never should have said buy the shoes, not the stock. And I said, well, look, the reason you said buy the shoes, not the stock, was because you thought the stock was overvalued. Something can be overvalued and can get more overvalued. But eventually, if it really was overvalued, the market will figure that out. Sometimes that just takes some time. And such was the case there. Nike would have been a really bad place for somebody to have, set and forget on the long side when he was on the air. So I don't know the last time he's seen that clip, but I'm going to show it to him today when he gets back home again. Okay. Steve Garcia says, yes, I bought a few cheap SPX put flies expiring April 30th. 61.75 is the short strike, which happens to be the 38% retracement fib from the tariff low to the high last year. This is a really good point, I think, here, and that is that I'll I'll pull up a fib chart, but that is that if you are going to do, ratio spreads, if you are going to, I'm going to get rid of these grid lines because I don't think that really helps us. It's just too many lines on here with the grid, so let me just get rid of that. So 61.75 right here, basically. That's that fib line that you're talking about, as we can see. So if you're going to do a ratio spread where you're willing to get very specific, have a number in mind, and I think that makes a lot of sense, as you do here. And we don't need the moving averages either. This should be a little bit cleaner like that. So, yeah, I mean, you have a target. And that seems like a very reasonable one to choose, admittedly. I probably, at this point, am getting to a point where I'm almost inclined to just do 1x2s instead of something like a fly, because I feel like if we get back to this region where we just bounced off of, I think that we can start, shooting against some of these other numbers, like the formal bear market as a place to get long. That would be intriguing to me. So a 1x2 put spread in that region would be interesting. Let's put that in so I can sort of show everybody what that. So just bear these prices in mind, because I'm going to use the open interest charting package for this, because I think it's illustrative. This is one of those times when I like to have there's a lot of text up here. The crack staff was good enough to say, sometimes, especially with these ETFs, you get a lot of, if you have some foreign shares, you get a whole lot of stuff in here, and that just becomes a bit too noisy. So we all know what SPY is, right? So we'll just put that there. We don't have to be clouding up the picture with everything else. So let's just say that we're looking out towards the, we'll go out 1 month. It's April 1st today. Happy April Fool's Day. And you want to buy a put, a ratio put spread. So maybe here we're looking at, what was today's close? 65.75. So maybe picking up something like this. We'll go down to, let's see, 637. I was looking, I think, at the 6. We'll go to the 625s or something like that. Buy 625, and sell a couple lower strike puts down here, and you'll see what I'm talking about in a second. So in a situation like this, oops, that's a one-off. That's not what I meant to do. I have to tab out of that. So you can see here that this is basically an even money trade. It's actually for a credit. So basically, because it's a credit, you're not going to lose any money on this trade unless it gets below this level here. See? And that happens to correspond essentially to that lower portion of the range, or even if you got back down to that, 575-ish level. So that's kind of the idea, right? That when if you did a fly, as Steve did, then you're going to end up with some negative numbers in here. So it'd be slightly red here. Then you're going to get profits in this region that aren't going to go quite as high. And then it's going to come back down. And then it's going to be red again. Whereas the trade I'm talking about here with just the 1x2, it's not going to lose anywhere on the upside, and it's going to have these kinds of losses because you're net short a put down in this region here. But I think that that's not a terrible thing, because you're talking about getting long the S&P at a pretty substantially lower level than where we are right now. So different ways to skin it. I do like the idea, though. number one, of using those narrow put spreads as a binary option. If this happens, then I want to get paid a certain amount of money, but I'm willing to just kiss off a small amount. And also bearing in mind that for longer term investors, pullbacks generally do represent better buying opportunities, of course, right? Because in the long run, equities rise. The real reason that we're talking about these kinds of trades, though, is because we have this uncertainty and we are in an environment where the probability of going into bear market territory is above average. Because, number one, we got into correction territory in at least two indices and very close in another. And two, that is with a backdrop of something highly inflationary, and that tends to significantly increase the likelihood of a bear market. So whether you decide to do it with a more of an ultimately bullish tilt, which would be like this, a 1x2, or whether you decide to do a more targeted approach, which would be something like that put fly, you do need to find ways to sell a little bit of premium to make these trades work, because the downside puts have gotten so much more expensive than they were. All right, let's see here. Tucker D. Dog, Trump giving speech tonight, so tomorrow he can change his he could change his mind and just say April Fools. Great. Yeah, I don't know that's I don't think that's really how investors want to have to contend with things, but that's funny. Okay. Mike says, what's your opinion about public and auto trading via an agent to make decisions regarding options trading based on user vibe code? So, agentic trading is very likely the way of the future, as far as I'm concerned. I've been a long believer in the application of artificial intelligence. Here's the thing, right? So when I first started trading, I traded on the floor in an open outcry pit. And I had one of these things, actually not one of these, it was similar to this. So I had an HP 12C in my pocket, and I had what we called our sheets. And the sheets were very much what they sound like. It was just sheets of paper like this, and on those papers were matrices. And on those matrices, you would have volatility along one axis and the price of the underlying along another, and then the respective options prices. And basically what you could do is you could, model, for changes in vol and changes in price, essentially where certain options would be. And the other matrices would just simply be changes in price, and then you'd have your Greeks on them. And then, of course, we'd have it programmed into here, too, which seems crazy now. But that's how we actually made prices and options. So if you were going to buy or sell an option, the broker would come into the pit, and we would make a price. We'd make a bid and an offer that way with a handheld calculator and a bunch of paper. And then we would trade off of that. And then, we would trade the stock or get on the phone with a broker and trade the stock. And of course, that's not how it's done anymore. It seems crazy, right? So we use machines to do all of that nowadays, and that's exactly as you would expect. Technology is basically a one-way ticket in investing and in trading and in technology. Now, high-frequency trading shops, it's the Citadels, Jane Streets, Susquehannas, everybody else, they are measuring their latency relative to market prices in microseconds, not milliseconds, microseconds. That's essentially how fast they are clocking how quickly they get information, how quickly they process information, and how quickly they disseminate that information. The speed is such an important issue for trading now that there's a facility called NY4. NY4 is basically where the traders and the exchanges have their servers. And the latency issue is so profound that it matters a lot where your servers are based in that building. So, you want to be as fast as possible. Well, in such a world, much of this trading is not taking place with human decision making, because humans obviously can't process information in well, probably in a second, let alone in milliseconds or microseconds. So a lot of the investing and trading world is already doing these things algorithmically. And the number of people that do it algorithmically is only going to increase. In the same way that we have people using full self-driving cars, I 100% believe that we're going to have people who have automated trading and investing programs. And it will be agentic, so I think this is hugely important. And I have, the flip side of this is that I have used automated trading systems. Obviously, we had some that were fully automated. We had some that were partially automated. Doesn't always turn out so hot. And a lot of this stuff is getting beaten up on the backs of people who are professionals. I can remember very distinctly, we had an auto hedger. And I think I've told this story before, lost 6 figures in FedEx in seconds. Monday morning quarterback. In the early 90s on the Peak Coast, market makers weren't allowed to use a calculator. What could you use? A slide rule? On the Philex, you were not supposed to use computers. And you weren't, and once you were allowed to have a computer, those computers couldn't be connected to anything. But that's not really what happened. So Timber Hill was one of the first trading firms. Timber Hill was the market-making business that is associated with Interactive Brokers. So I don't think they exist anymore, but they were a little bit different because they had a hybrid role. You would have these guys and gals that were on a seat, and they could represent a customer order, and they could also make markets in it. And they were, in one way or another, connected to sort of the main brain of the trading organization. Ultimately, everybody ended up with handhelds that were in the crowds, and those handhelds were linked wirelessly. We were one of the very first to have that. So we needed to do that because we were trading dispersion. That is to say, we were trading the relationship between options prices on single stocks to the indices or ETFs of which they were constituents and their related vols, and all of these things are moving at once. So to know whether something was a buy or a sell, you had to have inputs not only for the securities prices in the relevant pit where you traded, but for all of the other securities that were within a given basket. And now, of course, nobody's standing down there doing this way anymore. But yeah, I think the short version, Mike, is that this is absolutely going to be a part of how everybody does it. Okay, MDM. Hi, Mike. Is there a high probability recurring income model by selling cash secured SPY or SPX 20 delta puts into each upcoming month under the assumption that the market is up 75% of the time? Well, yeah. So there have been different models of this done. There is a put-right index that was created by the SIBO, formerly known as the Chicago Board Options Exchange. And is that? I think maybe it's the put index. Is it put? Put index. Here we are. So the put index, that is this. And actually, I should put this into a logarithmic chart. That'll make more sense. So I'll do a logarithmic chart. This one is not the 20 delta, but it should give you a sense of what's going on here. Or maybe it won't, because that's kind of crude. One of the things you will notice, and the reason I wanted to put the logarithmic chart, that was not well drawn. What I'm trying to draw here, and hopefully I can do that, get through those lines. All right. Now I wanted to show you this. That's great. That's not very neat. I think I can do this a little bit better. Let's do this way. I'm going to do that. There we go. So I'm going to use a line there. And then I'm going to do another line from there to there. Okay. You probably can figure out why I wanted to draw two lines. And this is taking place right around the GFC. And that is that since the GFC, the returns on this as a strategy have not been quite as high as they were prior. Why is that? It could be that there's been more sophisticated, volatility sellers out there. It could be that the dispersion trade has gotten crowded. Now, why would that matter? The dispersion trade is I'm long single stock vol, I'm short index vol, or some proxy for index vol like SPY or Qs. And if implied correlation gets very low, then the volatility risk premium that I'm collecting on my short index side is not as great, but you can still see that it is it's positive. And in fact, another way to look at this is to say, okay, well, this is a pretty easy bit of math to do. You can see that this is about 1,000 right here. Okay, so if you did this at the beginning of January of 2000, and you continued to do it all the way through the present, you'd have about 3.3x your money through put selling. The issue with put selling is that, and it's a fine strategy. I'm not going to discourage anybody from doing it, but there's a certain personality type that's going to get this better than others may do. Actually, I won't go back quite this far because it actually makes it a little harder to look at. But one of the things you're going to observe is that this is the kind of strategy where you grind it out and then you have a big drawdown. And then, you grind it out and then a big drawdown and the same thing. And sometimes those periods can be prolonged. This is Volmageddon right here, by the way. Sometimes, no, actually, that's not Volmageddon. I'm sorry. This is the Q4 pullback. That's the taper tantrum right there. And sometimes not. So, is there something to be done there? Sure. Definitely there is. But, you have to be the kind of person who just, you hit singles, you just keep hitting singles, and every now and again you get kicked in the head. But you keep doing the same thing until you dig your way back out and you get something that looks like this. So it's a lower volatility than the broad market because you never have 100 deltas in this thing. The downside of a strategy like that is that if you look at something like a Sortino ratio, so a Sharpe ratio is taking a look at the volatility of a strategy relative to its performance. A Sortino is similar to a Sharpe ratio. The distinction is that it cares if you have a volatile drawdown, but it does not if you have a volatile spike. And actually, as an investor, that should make some sense, right? The idea is that it's not volatility we're worried about. It's volatile drawdowns that we're worried about. So the Sortino ratio is a more important metric than the Sharpe ratio is. And put strategies, short put strategies, will tend to have less attractive Sortino ratios because of that characteristic of single, 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 big drawdown, and then singles again. Monday morning quarterback. We traded in eighths and did the math in your head. Needless to say, we got picked off all the time. Yeah, no, I started trading in eighths also. So teenies were introduced after I first started as a floor options trader. So that was one of the things you had to practice, was just sort of getting used to doing math in eighths, quarters, 3/8 to a half. It's interesting because as far as pickoffs are concerned, we had maximum spread. So for example, how wide the spread could be was a function of the amount of premium in the option. So for example, a option that was worth $1.80, you couldn't be more than 3/8 wide. So, maybe you could be something like 1 5/8 at 2, right? That could be your price for that option. Nowadays, it seems that most options are tighter. And when we went down to teenies, we thought, how are we going to make money in teenies? Because to your point, if you're doing things in your head and with calculators and things are moving around quickly, but you can't move that fast, those bid-ask spreads were a big part of how you could preserve some edge. And actually, just the hedging was really expensive. I was paying over a penny a share to execute my equity hedges at the time. And now, anybody is going to be paying a whole lot less than that. I'm sure all of you watching are probably paying a lot less. But that was fairly standard, paying a penny and a half a share or more. $2 brokers, they were called $2 brokers because they would charge $2 to execute a round lot. A round lot being 100 shares. So if you called a $2 broker on the big board on the New York Stock Exchange and wanted to trade 100 shares, it's $2, 2 cents a share. If you're making markets and options, and your options bid-ask spread is a penny or two, it's going to be very difficult to make money if you have to cover all these expenses, and then you're hedging, you're paying away 2 cents on the stock. You can see how that's not math that works. But yes, I remember all of that very, very well. Okay, and what was the other thing? I'm pretty sure. So we talked about Newmont yesterday, which, as it turned out, I guess that was a little bit late because this thing ripped today. Oh, wait a minute. But we talked about it. Now that I think about it, the market wasn't closed. So if any of you managed to do that trade, and just as a quick reminder, the trade involved was a call spread risk reversal in Newmont. I think we were looking at the 190, 110, 130. Still like it on the long side, but you probably want to roll up to 115, 135 or something like that. I do think it's fine to be short the 130s or 135s in Newmont right now because I expect that it's probably going to bump its head, at one of these levels in here, which is just over $130 a share in that neighborhood. But the reason this is kind of attractive right now is because of this. As a way to be long in the miners right here. 2-month volatility, that's how far out I was looking, but 2-month implied volatility was, like in the 90th percentile yesterday. I'm not sure where we are today. Where are we? Very close to it. So it was like 91st percentile yesterday, 87 today. Options premiums are elevated. I think call spread risk reversals going out 2-3 months. Nice way to be in the miners. Newmont was the one that I was looking at. It's the only one that's in the S&P 500. Okay, so let's see what we have here. 7-figure mission. Hi, Mike. What's your opinion on P-Sky? I did great on both Netflix and P-Sky on the announcement. Really great. Looking for a new opportunity. Brief question. I know it's 5 o'clock. Thanks. Well, let's take a look. Looks like we're at a. Well, actually, wait a minute. This is what's the final deal here? And I actually saw that. I saw that Larry Ellison was guaranteeing. I want to say it was $40 billion or something like that. I mean, he's providing a huge personal backstop on all of this. But Netflix, let's just start with Netflix. I've described Netflix in the past as, a utility, kind of an unregular one. Actually, underperforming today, huh? That's interesting. That is interesting. I mean, I thought it was good that they did not win that. So the market responded appropriately on that. Let's see where we are in terms of the moving averages. I'm going to use Carter Worth's favorite. So this is kind of that tricky level right here. Kind of want it to get through there. And you can see how effective the 150 has been. You'd have been a buyer there, broke through here, but then recovered, so wouldn't have been the end of the world. And it's basically been a very nice trend line to use. It looks like we're probably going to test it here, but in terms of valuation, I think Netflix has been, really quite reasonable given their rate of growth. So we've got right now trading just under, we'll call it 25 times next year's earnings, with a 21% growth rate, 11 to 12% on the top line. Kind of a utility in my view. That has the benefit, unlike a power generator. PG&E, they're regulated. Netflix, not so much. And actually, they probably would have had more of an issue if they actually had been the winner of the Warner Brothers deal, because it probably would have attracted a little bit of antitrust scrutiny. So I still think that they're in position A in the streaming wars. These guys, here's my issue, and that is that this is a little bit more of a, I think it feels a little bit more like a vanity project, and the legacy players in media have not illustrated, to me at least, that they can get to the kind of operating performance that Netflix has been able to accomplish. So it does look reasonably cheap when you just say, okay, well, it's trading at 10 times 2027 numbers. That's fine, but you can see that the cash flow here a little bit dodgy. Now I don't know what kind of synergies they're going to find in here. But again, this is, I actually thought Warner Brothers was going to benefit from being a part of Netflix, but I'm not sure that they get the same benefit from being part of Paramount. Now, I will offer the following, which is that Paramount does have a streaming offering. I've seen it promoted fairly aggressively. And they got nowhere to go but up, really, in terms of their growth rates. So, in that respect, if they can at least just get to, say, a 5% top line, which is modest compared to what, Amazon is able to accomplish, what Alphabet is able to accomplish via YouTube, because they've been increasing their subscription side over there. But the thing is that I feel like Netflix, Amazon, and YouTube, Alphabet's offering, they have been pretty savvy about getting some of that must-see TV kinds of stuff that gets people to pay the big dollars. So Netflix has this huge library, everybody defaults to it, and then you start adding some of this live content, sort of almost like the pay-per-view type of thing, and I feel like they've really struck a nice balance. So as far as I'm concerned, Warner Brothers and Paramount really, they've got their work cut out for them. They've got to prove themselves. It's also interesting, by the way, now that we mention it, since we're talking about the Ellisons, what was interesting to me, the big layoffs that were announced this week, because I don't think we talked about those. Market's not really responding that well to it. I have also felt that they are spending an awful lot on the data side that it's not clear to me they can afford as much as some of the competitors. This is something I've previously mentioned, but I figured I would mention it again. These guys are taking on a decent amount of debt. They are obviously bringing their expenses down with those massive layoffs that they just announced, and I can't remember what the number is, but they were big. I guess they went out earlier this week. Look at that. Yeah, there we are. 30,000 people got an email at 6 o'clock in the morning saying don't race to finish your coffee because you're done here. And my understanding is that, it was all completely shut off within a very short period of time. Now, I know somebody, I haven't spoken to him in a while, friend of mine whose mom's on the board. I haven't, not that she's sharing anything with him super secret, but I was going to be kind of curious to hear his thoughts, hear his input, as somebody who's been watching this company and been sort of closely associated with them for a long time. What's the tenor, what's the mood over there? And is the mood internally at the high levels better than the stock price would suggest? For me, it's not something I'm super crazy about. And yeah, I think both Oracle and Paramount spending big bucks to get assets that they really think they want, whether it's a data center in Oracle's case or it's Warner Brothers in Paramount's, but it is interesting times for both of those outfits. If I was going to take a flyer on either, I think I'd probably take the flyer on P-Sky, on Paramount, for what it is worth. And with that, I have chewed up an hour of your time, an hour of your valuable time. I really appreciate it. Listening to me ramble on and the questions, I always enjoy those, and I hope you find my responses to them helpful. We are going to be doing a live stream at 4:30 tomorrow, and I think it's going to go out over, it may go out over my X handle, so at Michael_Co. It's going to be a little bit of an experiment with one of the technology things, and it's mostly associated with the fund side. So I'll be answering some questions that people have about the funds and things that are going on. I might talk a little bit more about restoration hardware and about Nike because, again, as I mentioned, those were positions that we were short, and we pressed those shorts into earnings, which were announced yesterday. I have not checked the blotter to see whether the traders covered those today, but net of the big declines, I'm assuming that they will, if they haven't closed them, that they probably will be soon because they've fallen so far already. So until next week, you can either tune in for that, like, subscribe, notification bell, and otherwise really look forward to seeing you all here on Monday morning at 4:15. Enjoy the long weekend. Thanks, everybody.